Hey everyone, and welcome to This Explainer. I am so thrilled you're joining me today because we're doing a deep dive into a company that has been making some serious waves recently. We're unpacking the Q1 FY27 results of Jubilant Foodworks. You know, if you've ordered a pizza or craved some fried chicken lately, chances are you've interacted with their massive ecosystem. But today, we aren't just analyzing the dough. We are lifting the hood on their complex financial metrics to see exactly what is driving their growth engine. Okay, let's dive into this, because the context here is absolutely fascinating. After essentially being a market underperformer over the past year, Jubilant Foodworks suddenly experienced a massive market rally. We're talking about a 19% surge in their stock price in just a single month. So what flipped the script? What changed the narrative so drastically for investors? If you've been watching consumer discretionary stocks, this turnaround is exactly the kind of case study you need to pay attention to. To figure that out, here's our sum of the parts roadmap for today. We'll be covering 1. JFL's market comeback, 2. Decoding Q1 earnings, 3. Domino's delivery resilience, 4. Popeye's hypergrowth engine, 5. The Turkish expansion, and finally, 6. Stock valuation and outlook. All right, let's jump right into Chapter 1, JFL's market comeback, rebounding from the lows. To truly appreciate where the company is right now, we have to look at the market sentiment surrounding the stock over the past several months. Like I mentioned, the stock has rallied an impressive 19% over the past month, hitting the 498 rupee mark. For a long time, the stock was just dragged down by margin pressures and growth concerns, causing a pretty sharp correction. But suddenly, the narrative is shifting. Brokerages are actually turning positive, largely because they're anticipating a sequential improvement in revenue and a really strong recovery in margins as we head into the September quarter. So, what exactly gave the market this renewed confidence? That brings us to Section 2, Decoding Q1 Earnings and the Macro Picture. And this brilliantly illustrates what triggered that optimism. Let's look at this turnaround on a consolidated basis. Jubilant actually beat expectations. We're looking at a top-line revenue growth of 14.1%, bringing total revenue to 2,569.3 crore rupees. Meanwhile, the bottom-line net profit edged up by 6.3% year-over-year to hit 100.28 crore. Group EBITDA also increased a solid 15% year-over-year to 504 crore rupees. These are healthy, steady numbers, right? They really prove the company is navigating inflationary pressures with some real operational resilience. Let's move to Chapter 3, Domino's delivery resilience, the anchor engine. Because honestly, consolidated numbers only tell part of the story. To understand Jubilant, we really have to look at its core business. Domino's India is such a fascinating study in shifting consumer habits. Overall, Domino's India revenue grew by 7.4%, but underneath that headline number is a tale of two entirely different channels. The dine-in channel actually saw a 10% dip, creating some real margin pressure. However, this was completely offset by a robust 12% growth in the delivery channel. Get this, delivery now accounts for roughly 3/4 of their total revenue. For investors, this proves their pricing strategy, like reducing the minimum order value for free delivery from 149 down to 99 rupees, is successfully buying them crucial market share. Now, what's really undeniable here is the sheer scale of their operations. During the quarter, Domino's India expanded into 19 entirely new cities, bringing their total reach to an incredible 540 cities. And they're achieving this reach by increasingly opening smaller 600 to 700 square foot delivery and carry-out stores. That move actually reduces their capital expenditure per outlet by nearly 20%. It's a highly efficient, highly scalable model. Now on to Chapter 4, Popeye's hypergrowth engine, the rising star. While Domino's provides that mature, stable cash flow, investors are always looking for the next big thing, right? So let's shift gears from the stability of pizza to the startup-like explosive growth of Popeye's. 97%. Popeye's India nearly doubled its revenue year-over-year, hitting 70.3 crore rupees. This is pure hypergrowth. While Domino's is fighting for incremental single-digit growth in a mature pizza market, Popeye's is just rapidly taking a massive bite out of the fried chicken space. And they're doing it backed by superior logistics, a transition to fresh chicken, and fantastic store-level execution. And the craziest part, it's not just new store openings driving this. The like-for-like sales growth, meaning the growth of sales at existing stores, was a staggering 40 to 45%. And this isn't some one-off fluke either. This is the third consecutive quarter that Popeye's has delivered over 40% like-for-like growth. Average daily sales rose by half, and gross margins for the brand increased by over 100 basis points. That is huge. So, the crucial point is this. Management does not view Popeyes as just a side project. They see it as their undisputed second growth engine.
They have laid out an incredibly aggressive vision to scale this high-margin brand from its current 70 crore quarterly run rate to over 1,000 crore rupees in annual revenue within just the next 3 to 4 years. If they pull this off, it's going to completely reshape JFL's overall valuation.
Let's look at Chapter 5, the Turkish expansion through DP Eurasia. Because Jubilant Foodworks isn't just an India story anymore. JFL took a majority stake in DP Eurasia, which is the master franchisee for Domino's in Turkey, Azerbaijan, and Georgia. And this international acquisition is proving highly lucrative. Revenue for DP Eurasia jumped 28.2% year over year to 665.1 crore rupees. But most impressively, this business is generating such healthy cash flow that it is fully servicing its own acquisition-related debt internally. It's a highly profitable venture, though it's worth noting management did mention a slight softness in their Turkish coffee brand Coffee due to some intense local competition. All right, let's move to our final section, Chapter 6, Stock Valuation and Outlook. The verdict. We've seen the macro numbers, the Domino's strategy, the Popeyes explosion, and the Turkish expansion. The market is clearly pricing in a lot of future success. The stock trades at a premium trailing PE multiple of around 86 to 88 times, which is well above the industry average of 61.8 times. Looking ahead, it's trading at 52 times its estimated FY28 earnings. But we have to be realistic. This premium valuation exists alongside some real-world headwinds. The company is navigating a leadership transition following the resignation of their senior vice president and CIO, Narottam Sharma. Plus, they're legally contesting a 46.91 crore rupee GST demand notice. These are definitely factors investors are keeping a close eye on right now. Which brings us to the ultimate question. Management is firmly committed to a long-term goal of a 200 basis point expansion in their standalone EBITDA margins. But with elevated inflation impacting energy and labor costs, the road ahead isn't perfectly smooth. Will the incredible hypergrowth boom of Popeyes and the resilient, highly optimized delivery engine of Domino's truly outpace those rising operational costs? It is the multi-million-dollar question for this fast food giant. Keep a close eye on those margins going forward. Thank you so much for joining me on this explainer, and as always, keep learning.